Imagine trying to pick the perfect moment to invest, refreshing your app every day hoping the market finally dips just enough so you can jump in, and then watching the S&P 500 climb without you. Now imagine doing the opposite, investing automatically, consistently, and without stress. No guessing, no timing, just a simple system that quietly builds your wealth while you live your life. That's the difference between chasing the market and using strategies that actually work. Welcome to Invest Education Hub, where we turn complex investing ideas into simple steps anyone can use to build long-term confidence and freedom.
This video is for educational purposes only and does not constitute financial advice. Always do your own research and consult a licensed financial advisor before making investment decisions.
So let's kick things off by talking about a problem that, let's be honest, every single one of us has faced. I'm talking about the modern investor's dilemma. This isn't just for beginners. I know people who've been investing for decades who still struggle with this. It's this constant tug of war happening in your head. The battle between wanting to make the absolute perfect move and the reality that the market is just this wild, unpredictable beast. This dilemma, it's the source of so much stress and, as we're about to see, a lot of bad decisions.
So what is it? What's the number one, biggest, most costly mistake that investors make year after year? You might think it's picking the wrong stock or buying into a bad company, but it's not. It's something way more fundamental. It's a mistake in how we think, a behavioral tick that happens long before you ever hit that buy button. It's this deep-seated belief that we can outsmart everybody else, that we can predict the unpredictable. And that belief, well, it leads us down a very, very expensive path.
And here's what that path looks like. These are the classic traps. First, trying to time the market. You've seen it, right? You're waiting for the perfect dip to buy, and instead the market just keeps climbing. Or you sell at what you think is the top, only to watch it go up another 20%. It's a recipe for madness. Then there's trading too much. The news is always screaming, do something, act now. So you do. You buy, you sell, you shuffle things around, and all you're really doing is racking up fees and creating a tax nightmare. And of course, the big one, emotional investing. You see your buddy making a killing on some new tech stock, so you jump in at the peak out of pure greed, and then you panic and sell everything the second it drops. We've all been there. It's a brutal emotional roller coaster that almost never ends well.
And what's the end result of all this effort? All this stress, all this screen staring, all this cleverness? Almost always, it's the same story. You end up doing worse. Worse than if you just bought a simple, boring index fund and just left it alone. All that work, all that anxiety for a worse outcome. It's like trying to take a bunch of complicated back roads to get somewhere, only to find out the main highway would have gotten you there faster and with way less frustration. Okay, so if trying to be a genius is actually the dumb move, then what's the smart move? What's the solution? Well, this is the best part. The answer isn't some complex new algorithm or some closely guarded secret. The answer is to embrace simplicity. It's about getting out of your own way and using a system that's designed to succeed in spite of our human flaws, not because of some superhuman skill. And that brings us to the S&P 500. Now, I want you to stop thinking of it as just a line on a chart or a number on the news. I want you to think of it as a piece of brilliant financial technology. It's a machine that's been expertly designed for one job: to capture the long-term growth of the biggest, most innovative economy on the planet, and to do it with almost zero effort from you.
So why does this machine work so well? Well, first, you get instant diversification. You own a tiny slice of 500 of the biggest, baddest companies out there. But here's the real magic. It's got a built-in self-cleansing system. It automatically kicks out the companies that are failing and brings in the new rising stars. So think about it. A company like Enron, which went bankrupt, it gets booted. A company like Nvidia, which exploded, it gets added. It's like having a sports team that automatically cuts its worst players and drafts the next Michael Jordan every single year, and you don't have to lift a finger. It's just a passive bet on American ingenuity itself.
And hey, don't just take my word for it. This quote is from Warren Buffett. We're talking about arguably the greatest stock picker who ever lived. He made billions by finding those needles in the haystack. And even he says that for pretty much everyone else, that's the wrong game to play. His advice? Don't try to find the needle, just buy the whole haystack. And a low-cost S&P 500 fund is the easiest way to do exactly that.
All right, so we've figured out what to invest in. Simple enough? But now for the next big question. How do you invest in it? This brings us to one of the oldest and most heated debates in the investing world. It's the classic question. When you have cash ready to go, do you dive headfirst into the pool all at once, or do you slowly wade in step by step? The answer has huge implications, not just for your money, but for your sanity.
Let's break it down. On one side, you have lump sum investing. This is when you take all your available money, say you get a $100,000 inheritance, and you invest all of it right now in one go. Boom, done. On the other side, you have dollar cost averaging, or DCA. This is where you take that same $100,000 and invest it in smaller chunks over time, maybe $10,000 a month for 10 months. One is a single, bold move. The other is a slow, steady, disciplined process. So let's look at the cold, hard numbers. Which one wins? Well, if you look at historical studies like this one, on paper, lump sum investing usually comes out on top. And the reason is pretty simple. The stock market, over the long haul, tends to go up. So the sooner you get all of your money into the market, the more time it has to grow and compound. It really comes down to that old saying, time in the market beats timing the market.
But, and this is a huge but, investing isn't done on a spreadsheet. It's done by human beings. We aren't robots who just execute commands based on data. We're emotional creatures who feel fear and regret and anxiety. And the mathematically best strategy isn't always the best strategy for an actual person living in the real world. The math is just one part of the story.
And this is where dollar cost averaging becomes an absolute superstar. Its true power isn't mathematical, it's psychological. Think about it. Imagine you invest that $100,000 lump sum on a Monday, and on Tuesday the market crashes 10%. Ugh, the regret, the anxiety would be crippling. DCA saves you from that feeling. It turns investing into a calm, automatic habit. And when the market does dip, you're not panicking, you're just automatically buying more shares at a discount. It's a game changer, especially for new investors who are terrified of getting started.
And that's really the key takeaway right here. The most brilliant strategy in the world is completely useless if you abandon it when things get scary. DCA is a behavioral tool. It's like an emotional seatbelt that keeps you locked in your seat during turbulence. It automates good behavior. And over a 30 or 40-year investing journey, that consistent good behavior is what's going to make all the difference. Okay, so the plan is simple. Dollar cost average into the S&P 500. It sounds a little boring, doesn't it? Which is exactly why so many people get distracted. They get tempted by all these smarter strategies they see online, the ones with the fancy names and the incredible promises of beating the market with less risk. Let's pull back the curtain on some of these.
First up, you've got smart beta. The normal S&P 500 is weighted by company size. Bigger company, bigger piece of the pie. Smart beta says, hey, let's try weighting it by something else. For example, a value fund might focus on stocks that look cheap, or a momentum fund might load up on stocks that have been going up the most recently. The idea is to tilt the odds in your favor by focusing on factors that have historically done well.
Then you have sector rotation. This is where you try to be a market psychic. The strategy is to constantly shift your money between different parts of the economy, like technology, healthcare, or energy, based on which one you think is about to take off. The goal is to always be riding the hottest wave, jumping from one strong sector to the next.
And beyond those, you get into the really complicated stuff, the quantitative models. These are the black boxes of the investing world. They use complex algorithms that analyze dozens of technical signals, things like moving averages and trading volumes, to try and generate perfect buy and sell signals. Super high-tech, super complex.
And when you look at the back-tested results for these models, wow, they can look incredibly tempting. I mean, look at this example. This model shows a much higher annual return than the S&P 500. But the really eye-popping number is the maximum drawdown. That's the biggest drop the portfolio ever took. The model dropped less than 19%, while the S&P 500 got cut in half at one point. So you're telling me I can get higher returns with less pain? Where do I sign up, right? It sounds like the perfect solution.
But here's where we get another dose of reality from Buffett. He's not one of those academics who thinks the market is perfectly rational. He absolutely believes that markets get crazy and that prices can be foolish, creating opportunities. But, and this is the critical part, he also knows that consistently taking advantage of those opportunities is an incredibly difficult, full-time job for the absolute best in the world. Which is why, for the rest of us, he still recommends the simple index fund.
Because here's what those seductive backtests don't show you: the hidden costs of complexity. First, it takes almost superhuman discipline to follow a complex model's rules when your own money is on the line. Second, models can break. A system that worked perfectly for the last 10 years might completely fall apart in the next 10. And finally, all of that buying and selling generates way more fees and taxes, which is a guaranteed drag that eats away at those supposedly higher returns. All right,
If this whole idea of cutting through the noise and focusing on a simple, disciplined approach is clicking for you, do me a quick favor. Head down to the comments and just type, "I invest with discipline." I want to see who out there is really committed to building wealth the right way. This brings us to what I think is the most important part of this entire explainer. We've looked at the market, we've looked at different strategies, but it turns out that the biggest risk, the biggest obstacle standing between you and your financial goals isn't out there at all. That's right. It's you, it's me, it's us. Our own human nature, our instincts for fear and greed, our desire to avoid pain. That is what causes more portfolios to be destroyed than any market crash or recession in history. And we make these mistakes all the time. We get sucked into the 24/7 news cycle, which is designed to make us feel like we have to act right now. We see some stock offering a crazy 10% dividend and we chase that yield, not realizing it's often a giant red flag. And my personal favorite, the constant need to tinker. We can't just leave our portfolio alone. We have to optimize it, moving a little here, a little there, and every one of those little moves feels productive, but together they just sabotage our long-term plan.
And if you need proof of how costly these behaviors can be, just look at this number. This is staggering. Over a 20-year period, if you were just invested and held on, the S&P 500 gave you a 9.2% annual return. But if your attempts to time the market caused you to miss just the 10 single best days in that entire 2-decade span, your return gets crushed, dropping all the way to 5.4%. Just 10 days. Missing less than 1 day a year on average cut your wealth-building power nearly in half. That is the devastating price of trying to be clever.
This is the core truth you have to burn into your brain. It's not the market crash that destroys your wealth. It's selling in a panic at the bottom of the crash. It's not the recession that ruins your retirement. It's abandoning your strategy out of fear. Conquering the enemy in the mirror is the final boss of investing. Okay, so after all of that, after looking at the common traps, the shiny temptations, and the real enemy, what's the plan? What is the simple, powerful strategy that actually truly wins in the messy real world? Here it is. It's not a secret formula. It's a 5-step discipline. 1. Invest regularly. Set it up on autopilot with DCA. Make it a habit, like brushing your teeth. 2. Keep it simple. Use a low-cost, broad market ETF, like one that tracks the S&P 500. You don't need anything fancier. 3. Reinvest every single dividend. This is the fuel that supercharges the engine of compounding over time. 4. And this is the hardest one. Stay the course. When the market is down 30% and your gut is telling you to sell, this is where you win, by doing nothing. And 5, zoom out. Think in decades, not days. You're not playing for next Tuesday's returns. You're playing for your retirement in 2050. And it all comes full circle, right back to the simple, timeless wisdom of Warren Buffett. It's not about being a genius. It's about building a system that protects you from your own worst instincts. Put a set amount aside every month, no matter what the news is saying, and just let the incredible power of the global economy do the heavy lifting for you year after year after year. Building wealth isn't about timing the market or finding a magic formula. It's about consistency, clarity, and sticking to strategies that work in the real world. If this video helped you understand how to invest smarter using the S&P 500, hit like, subscribe, and share it with someone who needs simple, reliable guidance. Here at Invest Education Hub, we help you make clear, confident money decisions that protect your future and unlock long-term growth.